Hello everyone, welcome to Kamat's Academy. Today I'll be teaching investment decision chapter under financial management. This is Vignesh Kiran Kamath and let's begin with the session. Let's see the meaning of investment decision. So investment decision means it is the decision regarding investment of funds in long-term assets or in short-term assets. It's called as investment decision. What do you mean by long-term assets? Long-term assets are those assets which can be used for a long period of time, more than 1 year. Okay, for example, you can say regarding machinery, buildings, etc. are all the examples of long-term assets. And when we say regarding short-term assets, are those assets which can be used only for short period of time, are called as short-term assets. Another word for long-term assets, we call it as fixed assets. Short-term assets, we call it as current assets also. Okay. Now here in this diagram, you can see that there is word written capital budgeting and working capital management, right? Here, capital budgeting means decision regarding investment in long-term assets is called as capital budgeting. Decision regarding investment in short-term assets is called as working capital management. In this video, okay, we are going to discuss regarding the concept of capital budgeting. You will be seeing with the meaning of capital budgeting in the next slide. Okay, the working capital management is the another chapter. Okay, capital budgeting meaning. It is a decision relating to investment of funds in long-term assets or fixed assets which yields return over a long period of time. So this is the meaning of capital budgeting. I hope you have understood the meaning of capital budgeting. Now let's look at the definition of capital budgeting. According to Charles T. Horngren, capital budgeting is long-term planning for making and financing proposed capital outlays. Now let's discuss methods of capital budgeting. So here under methods you have mainly two methods. Okay, one is traditional methods and another is modern methods. Okay, the first under traditional method you have payback period method and accounting rate of return method. These are the two methods under traditional methods. And under modern methods you have net present value method, profitability index method and internal rate of return method. We will be solving problems regarding all these methods. Now you may have a question in your mind, why are these methods used? Okay, these methods are used for evaluating various projects. When we discuss regarding the steps in capital budgeting, in third step there is a step named evaluation. In this step we are using these methods for evaluation of various projects. Okay, let's discuss with the steps in capital budgeting. Okay, the first step is identification. Find potential investment opportunities from different sources like employees, market trends or new technology. The goal is to list projects that can benefit the company in the long run. So first step says that the finance manager has to identify various projects. Okay, identify various projects available. Okay, so that is the first step, that is identification. Second step, screening. Check if the project is practically by asking, does it match the company's goal? Let me explain in simple. First, before explaining this in simple, we'll see what is the meaning of screening. Screening means filtering. Okay, filtering the non-essential and keeping the essential projects. Okay, so that is the meaning of screening. So here the second step of capital budgeting, screening, means the finance manager has to separate all the non-essential projects and has to keep essential projects. Okay, now this separation or screening is to be done on the basis of whether it is matching the company's goal or not. Okay, so on taking this as the basis, the finance manager has to separate the projects, has to keep all the necessary which are useful projects, which are relatable projects, and has to keep, and later he has to remove all the unnecessary projects. And the third step is project evaluation. While discussing the method itself, I have said, okay, there are various methods, the traditional methods and the modern methods, right? So by using these methods, the finance manager has to evaluate various projects, right? So after analyzing the financial benefits using net present value, IRR, payback period, PI, ARR, right? The fourth step is project approval. Senior management or the board selects the best projects based on financial analysis and company strategy. So here, after the evaluation done by the finance manager, he has to submit a report regarding the evaluation to the senior management, okay, or to the board. So after this, the board gives their approval regarding the project. And the fifth step is project implementation, means once the approval is given by the senior management or the board, that project is to be implemented. So here, execute the project, use allocate resources and track progress to stay on schedule and within budget. Okay, so that is regarding project implementation, that is the fifth step. Now we will see with the last step of capital budgeting process or steps in capital budgeting, that is follow up and review. Compare actual results with expectation, measure success using cash flow, profits and returns on investment, use insights for future improvements. So after the implementation, the finance manager has to keep on doing the reviews and keep on doing the follow up. Now I will be teaching you the most important format. After learning this format, you will be able to solve the problems without any difficulty. Okay, now I request you to pay your 100% attention to this format while I am teaching. Later on, you can take a note of it. Okay, the format may not remain the same for all the questions. Okay, there might be modification based on the scenario, but trust me, if you understand this format, you will be able to solve the problems very well. Don't worry, don't confuse. While solving the questions, I will teach you how to apply this. Okay, now just you have to pay attention and understand this clearly. Okay, cash flows before tax and depreciation. I am naming it as CFBTD. Okay, CFBTD, cash flows before tax and depreciation. From this value, you have to deduct depreciation. Okay, depreciation. After deducting depreciation, you will be getting cash flows before tax. So I am naming it as CFBT. Okay, I am naming it as CFBT. Now, listen to this very carefully. Cash flows before tax means cash flows before tax after depreciation. Okay, now you might be confused. Cash flows before tax after depreciation. What does it mean? Here you might be confused with the word after depreciation, right? Now you have derived this answer, cash flows before tax, after deducting depreciation from CFBTD, right? When you deduct the value of depreciation, okay, you will get the value after depreciation, right? So the same thing here, cash flows before tax after depreciation. Here in sometimes in question it will be given cash flows before tax after depreciation. Then don't get confused, don't break your head. Then you have to consider the given value is regarding CFBT, that is cash flows before tax. Okay, from this value you have to deduct taxes. Okay, after deducting tax, you will be getting cash flows after tax and depreciation. Now, after deducting the tax value, you have got after tax, and you have already deducted depreciation, so it is after tax after depreciation. Okay, now the next step, you have to add a depreciation. The most important step, you have to add a depreciation. Now look at this also very carefully. Cash flows after tax before depreciation. I am representing it as CFATBD. Okay, CFATBD. Now, you might be confused with the word here. Cash flows after tax before depreciation. Okay. Now, as we have discussed earlier, after tax means you have deducted the tax value, right? Means here you have deducted the tax value, so this amount is after tax. Now in this step you have added depreciation, so when you add a depreciation it will be before depreciation. When you deduct a depreciation it will be after depreciation. Here you have added depreciation, so it will be before depreciation. So cash flows after tax before depreciation. Now we have come to know that there are various methods, right? Various traditional methods and modern methods. Now, the most important concept here, please keep a note of this. Okay. Now, you require this answer. Okay, take a note of this. You require the value of CFATBD for these methods. Take a note of it. NPV, PI, PBP and IRR method. Okay. For these method 1, 2, 3, 4. For these 4 methods you require this answer. Okay. Cash flows after tax before depreciation. Now there is one more method remaining, that is accounting rate of return method, right? So here for this accounting rate of return method you require this value. Okay, ARR. CFATD you require cash flows after tax and depreciation. You require this value for accounting rate of return. Okay, we will be, while solving the questions, okay, you will be able to understand it very clearly. Okay, now just make a note of it. Okay, you will be able to understand crystal clearly, okay, regarding how to apply and all. Now just take a note of it. Okay, now let's discuss some another concepts also regarding this format only. When in the question cash inflows is given, then you have to consider this value. Okay, CFATBD is nothing but cash inflows. You have to consider. Okay, cash inflows means cash flows after tax before depreciation. Okay, now sometimes in question it will be given gross profit. When gross profit is given, you have to consider CFBTD. CFBTD means the starting one. This value is also called as gross profit. Please make a note of it. Take the screenshot of the format for understanding. Okay, thing to be discussed in this format is, here we have used cash flows before tax and depreciation, cash flows before tax, cash flows after tax and depreciation, cash flows. Instead of cash flows, you can use earnings. Okay, you can use the first. When I use earnings, wait a second, when I use earnings in the place of cash flows, okay, both are same, there is no change, only in the format writing it will be changed. For your convenience I will be writing that also. Okay, when you use earnings in the place of cash flows, it will, the format will look like EBTD, earnings before tax and depreciation, less depreciation. Now what will be the answer? Earnings before tax, right? Now we have to deduct tax value, tax. You will get EAT, earnings after tax. Now the most important step, you have to add depreciation, EATD. earnings after tax and depreciation. Okay, now we have to add depreciation. While adding depreciation, you will get earnings after tax before depreciation. So this will be the format. Okay, and use earnings in the place of cash flows. Now similarly, when you use the word profits, okay, when you use the word profits in place of cash flows, okay, so in this case the format will look like this. So here also there is no change, only in the name it will be changed, okay, and other all things will remain the same. Okay, in sometimes for confusing the students and all, the question paper setter will set the question like this itself by using the word profits, or sometimes he will use the word earnings. If you have learnt only regarding cash flows, then you will be in the under confusion, right? So to avoid this situation, I have taught you in all the three ways. Okay, earnings, profits, cash flows are all the same. Okay, only the format differs, only the names of the format, other all steps of the format will remain the same. Okay, here when I use the word profits, my first step will be profits before tax and depreciation less depreciation, right? Now after deducting depreciation, profits before tax. Okay, now we have to deduct taxes. I will get profit after tax and depreciation, right? Now I have to add depreciation, right? Just in this step I have to add depreciation. I will get profit after tax before depreciation, right? Please make a note of this format also, and take a note of this also again. Here I'll be writing here in star so that you don't forget. Cash flows is equal to profits is equal to earnings. Okay, only the name differs. Please make a note of this. Okay, here whatever I have written in this slide, okay, make a note of it. Each and every word is very, very important, even this point also. Okay,
this was all about the concept building and the theory part. Now it's time for you to watch videos regarding various methods and their problems. If you were able to understand the way I teach, then please like this channel, give a comment regarding my teaching, please share with your friends, and please do subscribe. Thank you.